So this video is one of many that's going to touch on how to solve option questions for an Intro to Finance course, typically for undergrad students. There's really three things that you will need to know how to compute or how to accomplish within an options questions for a Intro to Finance course. The first one will be, how do you compute payoff? How do you build a payoff diagram and or a payoff table? And then how do you compute profit? Now, some of these questions will have a profit portion to it and some will not, but it's really important to know the basic skills that are required for these types of questions and really just practice it because it's actually super simple. So let's go through it together. You'll see how I identify things, what is my methodology when I look at questions like these, and how do you score maximum points. Now, I apologize, it's a little bit loud outside. It's just because there's, trucks passing by and whatnot. So sometimes you may hear me a little bit like worse than other times, okay? So let's jump into it. The first step is to literally just read through the question. It's as easy as that. So we know that a share of Shy Design's common stock has been consistently trading at $28 per share. Now suppose that Sarah buys a Shy Design call option with an exercise price of $48. This is super crucial. And she sells another Shy Designs call option. So we're going to just maybe highlight buy, or highlight sell. Another call option with a $68 exercise price. This is awesome. Now note that both options have the same maturity date, and we want you to consider the following information in order to draw a payoff diagram for the purchase of Shy Designs $28 call option, and a payoff diagram for the sale of the $68 call option. Sorry about that. And a payoff diagram / table for the entire portfolio. Now I'm going to give you an easy trick. We're always going to do the same thing when we do these questions. And in order to complete one, in order to complete two, in order to complete three, you really have to go through this option regardless. And that's to build a payoff table. A payoff table will be the most crucial tool you will use when computing for options payoff, options profit. Even PhDs will use this technique. It's just a fail-proof way, okay? So just a few things before we begin, just to give you an additional set of context, is that we're buying, okay, one call option, and we're gonna sell another call option, okay? So really important to remember that. So just always try to highlight this. So one will be a purchase of a specific call option, and then the second bucket will be the sale of a specific call option. And these two actions, these two positions will consist the positions within our general portfolio or a general like investment thesis or decision, okay? So let's go about building this darn payoff table. It's super simple. It's literally the coolest thing. I mean, it's not the coolest thing ever, but it's definitely easy. So what you gotta do is simply right here, positions. So we're gonna highlight, all right, a few columns. So we're gonna have our positions, all righty. And then in this segment here, we're gonna have essentially stock prices, okay? There's not a lot of space, so I'm gonna write stock prices. So we're going to assess a bunch of different stock prices, and we're going to assess what is the value of that call option that we purchased and what is the value of that call option that we sold based on different stock prices. So we're kind of like running a simulation of sorts, okay? But before we do that, before we go into those columns, I'm just going to highlight 3 important rows for this type of question. Actually, 2 important rows. They're going to be divided into 2 categories. One, those rows will be all of your positions, okay? And then the second segment of rows that we need to deal with is going to be our rows for our payoff, okay? That's what we really care about. It's okay if that doesn't make the most sense just yet, but by following the steps, it'll be very, very valuable. So let's draw up our first row. Let's draw up our second row, okay? And then naturally, we're going to have payoff as our last. Okay, now the first row here will be the buy call at $48, okay? And the second one will be the sell call at $68. Okay. Now, these are two different positions with two different sets of implications and two different exercise prices. And for that reason, it's that much more important to go through all of it. Okay. Go through them like individually. So how do we find the different stock prices that we want to place onto our payoff table? This is something that a lot of students struggle with, and I understand and I empathize with that because I was there. And there's there's a simple trick to take here, okay? The first trick that I definitely try to highlight is the question, it gives you a bunch of different prices. So why not just plug all those prices within your payoff table, okay? So we have $28 as one price. We have $48 as another price. We have $68 as another price. Already there, we have three monetary values that they've plugged in out there for you. Well, let's just plug it in within our payoff table. That's the very much so the bare minimum that I need you to do. Okay. Then the next step, okay, is a trick that I call a lower and higher extreme. It's a trick that you could call as lower and upper bounds. Essentially, you just want to find the most extreme cases of stock prices that could happen. Okay, so I guess I'll write it at the top. The extreme technique. Let's go with that. That's kind of funny. All right, the extreme technique. All right, and the extreme technique, it really tries to highlight two prices. And I guess we're going to call it the extreme technique for selecting stock prices in a payoff table. All right. That's going to be your extreme technique for selecting prices in your payoff table. Essentially, you're looking for two things, okay? And I guess we'll maybe make it that. Yeah. So we're going to have a little framework. We're going to look for a lower bound, okay? So a lower extreme, and we're going to look for a upper bound, okay? Lower bound, upper bound. Now, what's awesome is that the lower bound is actually really easy to solve for. Okay, it's really simple. Your lower bound, your lower extreme will always be equal to $0. That's a lower extreme that we're always going to place in within our stock payoff table, because we just want to see, well, what would happen, right, for your call option or your put option or your purchase of a call or whatever, if the stock price was $0. It's an easy lower extreme. And I mean, you can't go any lower than $0. I mean, it's just the name of the game. However, in terms of your upper bound, there's actually two ways to go about it. I kind of freestyle with it. It's sometimes never really actually going to do anything for your question, but it's important to have because it may give you a comprehensive view on what to do. So your upper bound, what you could do is you could simply take, if you want, your largest amount. So we're going to call your biggest amount. So your largest value plus your smallest value. Okay. So in this case, we would have $28 plus $68. That would be your upper bound. That's one way of going about it. Another way of going about it is by simply taking your, I would take your low, listen, there's really a bunch of different ways. I usually go for lowest value plus, largest value plus smallest value, because it's typically going to give you a really good extreme. However, in the case that that doesn't work, what you could do is you could add two of your positions together. Okay, two of your positions together. So I'm going to write down what that would look like for y'all. Your lowest value would be, in this case, 28 plus your highest value, which would be 68. In this case, what you could do, perfect. Let's go with that. You know what? I'm going to take a step back and I'm just going to make it easy for y'all. We're just going to go with one method because my technique is pretty much trash right now. I'm not going to lie. And if in another video we need to adjust the technique, we will. So yeah, you just take your lowest value plus you take your, lowest value plus your greatest value. Okay, so small plus big. All right, let's go with that. I'm sorry for the lack of conciseness. That's on me. I really do apologize, but still, what I want you to know is that that's going to be our technique. And with that, we could actually start plugging stuff in within our payoff table. Okay, so the first thing that we're going to plug in is going to be $0. Then the next thing that we're going to plug in is going to be $28. Notice how we're literally just plugging in all of the stock prices. Okay, then another thing that you could plug in will be $48. Another thing that you're going to plug in is going to be $68. And then the extreme value that we were talking about earlier, we're going to do simply here, take 68 plus 28. So 68 plus 30 is 98, minus 2 is going to have 96. So we're going to have $96 right here, and we can maybe extend these a little bit. Okay, so honestly, now it's going to be a piece of cake. It's going to be a walk in the park. It's going to be so easy to solve the remaining piece of this question. Now it's just about having a conversation together and being logical. So if we buy a call option, what is a call option? A call option is the right to buy a underlying asset at a specific price for a specific amount of time. In this case, we're telling you that you have the right to buy the common stock at $48, right? For any given period of time in this case. So you could buy this stock at $48 instead of the price on the market. Okay, that's a pretty cool news because depending on the price in the market, you could actually like really benefit from this opportunity. And you're going to see exactly that in a second. So let's say that the common stock is trading for $0 on the market, and you have the ability to buy that stock at $48. You know, if you could buy it at $48, right? If you could buy it at $48 or you could buy it at $0 on the market, where are you going to buy it? You're going to buy it in the market. Why would you spend $48 when you could spend $0? Okay. So of course you're going to buy it in the market. And then in that case, your option will not be exercised and your option would be rendered useless. It don't matter. We don't care about it. For that reason, the payoff, the benefit, the savings you would have had on that option would be equal to $0. Okay, so you get the notion here. If the stock price, okay, is smaller than the call option, right, the exercise price of the call option, your payoff will be $0. If the stock price is higher than your call option, your payoff will be the difference between the two. You'll see what I'm saying in a second. So let's think about it still. Okay, if the stock price is $28, all right, in the simulation, and our call option is still $48, we would still not use it because it would hold no value to us. We'd rather buy in the market at a cheaper price. All right. Now, if the stock price is $48 and our option allows us to buy that stock at $48, well, we're indifferent. They're both going to be the same price, and we're still not saving any money. We're still not making any money. So in this case, our payoff is $0 still. Now, what happens if the stock price is $68? Okay, so you have two options. Either you buy the stock at $68 on the market, or you exercise your call option, which allows you to buy it at $48. Now, I don't think you're a fool. I think that you like to save money. And in this case, we are going to save money, and we're going to buy it at $48. And if we buy this option, if we use our option at $48, that means that we saved $20. That's amazing stuff. That's dope. Okay, so we just saved $20, and that's going to be our payoff. Now, if it's $96, the same idea applies, and it's going to be simple. It's going to be $48. It's going to be our payoff. Okay, so that's if we have a call option that we purchased that we could exercise within a subset or a set of different potential stock prices. But now let's look at the call at $68. Okay, and how I like to exercise this idea of a call that we're selling is always just acting like we bought it. Okay, acting like we're going to go through the same framework of we have a call at $68 and we want to know when are we going to exercise it. Let's just go through that idea. So if the stock price is $0, we're not going to exercise it. If it's $28, we're not going to exercise it. 48, we're not going to exercise it. 68, we're not going to exercise it. And then in this case, we can do some quick math. The difference will be $28. Okay. However, what's important to note here is that if we're selling a option, okay, we're selling a call option that could have made us money. This is akin to us losing money. We lost an opportunity to make a payoff of $28. We lost the opportunity to make a payoff of $28. So in other words, this would be low-key negative. It's going to be a negative minus, it's going to be negative $28 because we lost that opportunity. This is going to be minus 28 because we lost that opportunity. Now, that's how I will want you to kind of look at it. We lost an opportunity, and for that reason, that's an opportunity cost. And for that reason, it's a negative outcome on our general payoff. Okay, so that's the framework to use. Don't you worry, we have more complicated questions in which I go a little bit more in detail, but for now, that's what you want to know. Okay, so if we look at a general payoff of this like portfolio, we notice something really interesting. We notice that, all right, and by the way, how do we solve for the general payoff of a portfolio is that you just need to add your rows together. Literally, your payoff will be the sum of all your rows. So if the stock price is $0, your payoff will be $0. If it's $28, your payoff will be $0. If the stock price is $48, your payoff will be $0. If it's $68, your payoff would be $20, and if it's $96, your payoff would be $20. So what's really interesting is that you notice that your payoff seems to trend, all right, at $20. This is where our payoff trends. And it's even a fair bet to say that our payoff will trend at $20 kind of like continuously forever. Okay, so that's pretty awesome. So that's really good to know. Now, if we were to draw a payoff diagram about this, okay, if we were to draw a payoff diagram about this, it's kind of threefold. And I guess we'll do just that. I'm trying to find a place where we could do it. And why not? We'll do it right here. Sorry if it's not the cutest thing ever. Okay. So what we're going to do is we're going to draw up a little payoff diagram for you. So notice how here we're going to have the stock price, and here we're going to have our payoff. Okay. And we're going to draw up a few random points. We're going to have 0. We're going to have this one. We're going to have 5 points. 2, 3, 4, and 5. So this will be $28. This will be $48. Actually, we only really need 1. So I'm going to erase 1 real quick just for y'all to see what we're up to. All right, 48. 68 and 96. Okay, and we're gonna kind of do a little legend together. So orange will be the color that we're going to take for our individual purchase of a call option at an exercise price of $48. Pink will be the color that we're going to take to draw up the position of our sale. And then I don't know what's another color. We'll take this color blue here for the general payoff of our portfolio. Okay, so I'm gonna draw it up for y'all, and it's pretty awesome. As you can notice here, that all the way to $48. Okay, we can draw it up here. All the way to $48, our payoff for this position is equal to $0. However, at $68, I guess we'll have to maybe kind of outline them here. We're gonna say payoff could be 20, 48. Okay. And we could say that at $68, right, our payoff will be $20, right? We go right here. And then after that, at $96, our payoff will be $48. So that would be our payoff diagram for our purchase of a call at a exercise price of $48. Okay, it's as easy as that. You just got to draw it up like that. It doesn't get any complicated. Okay, I promise you. All right, and if we go to our pink color, if we go to the sale of our call, what's interesting is that you notice that at $96, we actually have like a loss. Now, of course, it's not really a loss. It's more so us like omitting or like refusing a very cool payoff. So it'd be $0. I guess I'll just draw it over. Why not? And essentially it would be $0 all the way to 68. And then it'll go down all the way here to minus 28. Okay. Now, of course, in my payoff diagram, I literally just didn't put anything for the prices that are underneath zero, but the payoffs that are underneath zero, but you get the idea. So that would be the payoff for our purchase of a call. That's going to be the payoff for the sale of our call, right? Because we lost that opportunity. We foregoed an opportunity. Why not? Basic English. And what's awesome now is that we could draw off the payoff for our blue line, okay, for our general portfolio. In this case, it's the same almost. It's $0 all the way to 48, okay? And then it will remain at $20 kind of forever, low key. Just like that. And it's going to stay at $48 forever, infinitely. Okay, so it's going to stay there forever. And that's going to be the payoff of our portfolio. So that's how you do it. It's as easy as that. I hope that was clear. I hope this was simple. I hope you now understand the tricks we need for to solve a options question. For sure, the first time it could be complicated, and for sure the first time it could be daunting. But what's awesome is that the more you give it a shot, the more you're exposed to it, the easier it'll get for you. Okay, so I'm pretty stoked about that. And that said, sorry, I kind of zoned out, but that said, I hope this helped, real talk. And there's so much more resources on eastmahelps.com. There's so many more resources on my YouTube channel where I really talk about the essence of having a a call position and a put position, and then buying one and selling one, and what does that mean for a payoff diagram and a payoff table, and how we compute profits. So this is just my attempt to try to help you out, to try to give you a shot to really do amazing in your classes. And yeah, hopefully I see you in the next video. Hopefully you'll do amazing. And that's why it's for free, because I really want to help. See you next time.